Bon dia, buenos dias. Good morning from the sunny San Francisco Bay Area. My name is Andy Tsao. I lead Silicon Valley Bank's Global Gateway business, which today is the center of business development and relationship management for startups, scale-ups, and investors in innovation hubs outside of the US, which certainly includes Latin America. I'm delighted to welcome you to the fourth annual edition of the SVB LAVCA webinar on VC trends in Latin America, where we're going to be discussing LAVCA's most recent data. I want to thank our partners at LAVCA, Carlos Ramos de la Vega, Kate Ambrose, and the entire LAVCA team for their collaboration on this series of webinars. They've been invaluable partners for the bank in our journey in Latin America, which began nearly 15 years ago. SVB has had the privilege of working with fantastic founders and venture capital investors, including nearly all of the unicorns in the region. We at SVB continue to view Latin America as strategic, given the amount of business opportunities that tech can solve and the abundance of great entrepreneurial talent to go after those opportunities. We at SVB are very much looking forward to working with this and the next generation of great founders and investors in Latin America. So for today's program, we'll hear first from Carlos, head of VC for LAVCA, on their most recent report, 2025 Trends in Latam VC and Tech. Then we're going to turn it over to my colleague, Toro, head of Latin America at SVB, who will moderate a fantastic panel of VCs to talk about what they are seeing on the ground, including my good friends, Bianca Martinelli with Alexia, Lara Lemann with Maya Capital, Hector Sepulveda with Nazca, and Antoine Colaco with Valor Capital. Before we get started, though, I thought it'd be interesting to get some context on what's happening in the US innovation economy, which has been on a tear as far as venture capital deployment is concerned. We all know why: AI, and particularly funding of the large LLMs. I want to share two slides from SVB's recently released State of the Markets report and outlook for the second half of 2025. There's some great data in this report, and please use the QR code to download the report if you're interested. There's no doubt that the platform shift to AI is in full swing and dramatically impacting the funding environment. Let me focus your attention on the table for VC deployment in sort of the left-hand side. You can see that we're on pace to possibly eclipse the mountain of capital that was invested at the peak of the last cycle in 2021. We are forecasting, with 156 billion already invested, that we will see 340 billion invested for the full year 2025, just shy of what was invested in 2021. How times have changed. There are some significant differences, though, between 21 and this year. As the slide's entitled, mega rounds of over $500 million dominate, accounting for 2/3 of all capital invested, while in 2021, mega rounds were only 18% of the total. So while the total numbers are record-setting, it's highly concentrated, and you only need to look at OpenAI's latest $40 billion funding round, which would account for 12% of the total that we're projecting in 2025. So if you consider that there's a tremendous amount of capital being invested in the US, this slide would suggest that things aren't as rosy as they may seem. Graduation rates between funding rounds are falling to an all-time low. You can see in the lower left-hand side that only 9% of companies who are trying to raise a Series A were able to do so within 3 years. And you contrast that in 2020, when twice as many, that was happening at twice as fast at 22%. This phenomenon, in part, is caused by investors who are providing bridge funding to allow startups sufficient runway to close a proper funding round. However, at this current pace, it would take more than 10 years to go from Series A to Series D. That's about 45% longer than it would have taken in 2022. However, there are some silver linings as we look toward the remainder of the year. The IPO window is still somewhat open, and we've seen increased M&A activity as well, and that's going to provide some much needed liquidity for the innovation economy. It also seems like the US Federal Reserve is poised to lower interest rates, but in this unpredictable environment, we really won't know until it happens. Please check out our latest State of the Market report to read about these trends in much greater detail. So that's a little bit of what's happening in the US. And let's turn it over to Carlos to get the latest on Latin America.
Thank you so much, Andy, for that. Deeply appreciate the long-standing partnership we have with SVB, and thank you for the amazing group of investors joining us today. We'll keep it short. It's not going to run long, this part of our data and insights, but we thought it could be interesting to just walk you through what's the latest that's happening in the ecosystem with the latest report we published, the Ecosystem Insights report focused on Latin America specifically. And how does that fit into the broader picture? So that's why Andy's data was so interesting in the US. So if we can actually go to the next slide, please, we can actually start with what's happening on a half-year basis in the ecosystem. And if we were to frame it in a very specific way, we could say that the ecosystem is going through an area of evolution, consolidation, and some reframing, right? And some comparisons have been made in the past about what has happened in this quarters, in this half year, with what happened in 2019 and 2020. But the ecosystem is significantly different from that, even though the VC investment deployment still tracks to be around $1 billion on average deployment per quarter on run rate. One of the things that is different here, as you can see, is before we didn't have venture debt as a very prominent tool for financing for entrepreneurs, and seed stage capital was actually not that prominent. So the mix has changed, definitely. And if we go to the next slide, we can see that also the geographic set has changed significantly as well. Before, Brazil was the leading market, and it still is in a lot of respects. But now we have seen that a lot of the deal flow and actually the deals that have been closed are actually going to Spanish-speaking Latin countries and startup space in those Spanish-speaking Latin countries. More than half, 54%, have actually done that. And here we actually see that Mexico surpassed Brazil for the first time, for example, in Spanish-speaking Latam, since the past 15 years in terms of VC investment. For whoever's been following the ecosystem, this is definitely not new. It's been around for a couple of months, this piece of news, but it's important to reiterate just because of the extent of the evolution of the ecosystem there compared to the Brazilian one, and how, even though this is just a data point and we cannot make it a secular trend yet, it is still important to recognize that a lot of the growth capital was actually concentrated this time around in Mexico versus Brazil. If we go to the next slide, I believe I talked a little bit about it, but this is, for example, the number of new startups that are actually getting funded, right? So in the past 18 months, more than 500 startups, 270 of them were actually in Spanish-speaking Latam, very prominently. A very important thing to consider here, though, is that what we consider a new startup that is getting financing is not really a startup that got incorporated that year. It's a startup that is going to market and fundraising for the very first time. So this can be a startup, of course, with these caveats, that has been trying to bootstrap for the past 2 or 3 years, and then they decided that they needed a little bit of third-party capital in order to reach certain milestones. So this can actually give you an idea of the healthiness of the ecosystem going forward, and how, if we annualize the number of the first half of 2025, we would be very much on par with the period of 2019 and 2020, right? We will be talking a little bit more about selective capital a little bit and capital availability in general, which of course affects these metrics as a whole. If we go to the next slide, please. We started doing this analysis a couple of years ago. We were trying to map what was happening beyond the traditional, what we call tech hubs, right, in Latin America, beyond the Sao Paulos and the Mexico cities and the Buenos Aires. And this can truly tell you a story of how it's been a consistent deployment outside of these main tech hubs. And of course, you do need some concentration of capital and some concentration of talent in order to hit that product market fit or that escape velocity. But at the same time, technology can be started and can be actually implemented from anywhere, as we can see here, right? So we see the rise of Panama, for example, in gaining investor attention. And of course, other cities in Brazil as it consolidates as a major hub at a country level. But very interestingly here, if we go to the next slide, is to not surprise to some, maybe to others, it is a surprise, but Montevideo is one of the hottest cities outside of the main hubs that has gotten a lot of investor attention and capital in the past couple of years. Just to say, here's a very broad ranking at a city level of some of the cities, across the ecosystem and how much attention and capital they have actually gotten and how many deals have been closed there. Montevideo went from the 28th place to the 7th place in just 5 years, right? We know this is a combination of seasoned operators and founders moving there, and some others coming up from the local mafia, for example, and some other startups that became public that are also based there or consolidated there. But for sure, this has been one thing on our radar, and of course, it's leading the charts in terms of growth and interest from investors. If we go to the next one, please. We also started tracking this a couple of years back, and this actually is full of numbers by stage, but I think it tells a story both of numbers but also of people, because if you look at the mean and median round sizes by stage, right, and compare, for example, seed stage, there's always been a very important gap between the median and average round size, because underwriting a specific deal or a specific opportunity, it's very, very, very hard when you have very little traction, right, in the ecosystem, and that's very explainable with the abysm, I'd say, from those two metrics, mean and average for seed stage. But when you actually become a more mature company, of course, you have more traction, price discovery is easier. It's easier to underwrite the risks of a specific company. So if you go all the way to the other extreme, and if you go to the Series C and Series C specifically, granted the universe set is a little bit smaller, but at the same time, you can see that this mean and averages converge significantly, and they're seen an uptick, especially in 2024. But there's nothing as significant as what we saw in 2020, 2021. Importantly here, though, is, of course, we see still a very continuous adjustment on Series B rounds, which we would consider usually the growth equity, growth capital side of the story, or early growth, where there's still opportunity there for additional stabilization on how investors are pricing certain rounds and the size of the rounds, the valuation of rounds. And of course, Series A continues to be a little bit of that chasm that we'll see in a second, the correlation rates that are actually very similar to what Andy said on the US level. But basically, the how hard it has become to go from being a seed stage startup to a Series A startup, given a bunch of different drivers and factors. If we go to the next slide, please. Here, actually, we'll start talking already about capital and investor selectivity. If you're a founder listening, or a C-suite or CEO listening to this webinar right now, it might not be a surprise to you that it has taken longer to actually close a round in the ecosystem. And that has been a secular trend that we can call this a trend that has happened since 2021. It keeps on increasing, and right now sits at around 20 months to be able to fundraise, regardless of the investment stage, right? We included also some numbers of the companies that were successful in raising a Series A and haven't raised a Series B, and haven't raised a C, and so forth here. But let's keep in mind that there's still some opportunity in how we frame the startups that will not make it to the next round, either because they decided to just bootstrap and they're just not going to market for additional capital, or plainly because they decided to shut down operations because there were better opportunities in the market as well. If we go to the next one, please. And I know that I'm rushing a little bit, but I'm just very eager to hear from our investors instead of just me walking through the data. This could be also a very interesting one at a granular level by quarter. We try to answer the question, if you're a seed stage startup, and if you raise successfully a seed stage round in a specific quarter, how long did it take you after a specific period of time? What was your success rate of actually, graduating into raising a Series A? So if you started in 2019, first quarter, after a year, for example, it took you, you had a 6% graduation rate for a Series A, for example, right? The key takeaway here that we see is that, yes, it has become much harder to go from a seed stage, for example, to a Series A round in the region. So again, we've gone after a year, a seed stage company, it has gone from 6% in 2019 to 1% with an average of 2. After 2 years, from 17% to 2. 3 years, 25 to 4%. This number, of course, naturally increases as time goes by because the company has more opportunity to prove itself. But at the same time, it tells a story of the type of assets and the quality teams that are getting funded, right? You would assume that the more selective an investor is for a specific opportunity and a business model, the better a vintage can be for a specific fund. So this can be, of course, seen on 2 ways, and we're very optimistic on the types of companies that are getting funded right now. If we go to the next one real quickly, this is also seeing that graduation rate impact, but by stage and also by sector, which we thought, I think it's important to double click on this and see maybe just specifically for one sector or the other. The only sector, for example, that does perform relatively well right now, it's again fintech, no surprise to anyone. But there's sort of other opportunities that have been reframed a little bit, and that's a concept that I talked about a little bit at the beginning, including, for example, the capital intensity of some business models in e-commerce, in last mile delivery, in logistics, in prop tech. So that is very in line to what we're seeing in terms of some startups having a little bit more of headwind trying to raise a new round of funding if they don't go through a pivot and actually reframe the way that they're approaching the market. If we go to the next slide, please. Here, again, we're trying to map what's been, captivating both headlines and cap tables in terms of sectors, right? Fintech has always been at the very top, but very interestingly, I just mentioned that e-commerce was having some headwinds in terms of certain business models. Well, even with that story still playing out and still being very valid, in 2024, for example, and in the past couple of months, we've seen that e-commerce has still reclaimed its second place as the second best funded category in Latin America. So again, we are talking that there's been a reframe from maybe like pure play e-commerce platforms to more e-commerce enablement, for example. So more like Tienda Nube, for example, a Nubem shop. And then, for example, very interesting cases and very disruptive cases like Mirama, which I'm sure Antoine can talk more about. IT services and CRM sales that you see right below e-commerce are sectors that we would consider enterprise software more generally. And as you can see, again, prop tech and HR tech have definitely fallen out of favor, at least in the way that they were being approached in the past couple of years. Not in terms of the general opportunity of the market, of course. If we go to the next slide, please. Here again, this is just to contextualize how fintech dominates, right? I don't think that we need to spend a lot of time on this one, but basically, usually we range between 45 to 50% of all dollars going into fintech. We're reaching already 61% this time around. And then I said e-commerce was following. It follows, sure, but look at the distribution. It follows with 5.6% of all total capital. So there's a big difference, and the story for Latam continues to be very fintech dominated and fintech forward. The next one, please. Here, I said that we're going to be talking about the good and, of course, the things that need a little bit more discussion. Whoever has been following the ecosystem for a couple of months, not only the ecosystem locally, but venture capital as an industry globally, there's been a specific conversation around the opportunity for fundraising and for exits and the relationship between both of them, and what is the unique strategy for fund managers to establish long-standing institutions with great track records and great portfolios. So let me start with the fundraising aspect here on the very left-hand side. Andy mentioned topics like monetary policy and the effect that it can actually have in global deployment. That definitely applies to Latin America as well. But another topic, for example, that is very important on the right-hand side is the amount of exits and the type of exits that the ecosystem has seen has also evolved over time, right? The IPO window is starting to open a little bit at the global level, and hopefully that's going to have a ripple effect in the coming semesters in Latin America. We are very much looking forward to that, as well as the public equity investor mindset and risk on mentality to, acquire and double down in assets in the region. But at the same time, for example, startups that were using part of the balance sheet to acquire other startups in inorganic opportunities have actually now doubled down on their core businesses and inorganic growth. And of course, there's some still selective cases in which, for example, there's been M&A opportunities with iFood acquiring a 20% of CRM bonus recently and others of the sort. But the reality of things is that exits is also very inherently intertwined. And we were talking about this a little bit before the webinar, on the fact that some of the limited partners are also basing their assumptions and how they can deploy systematically in the region with based on the capital that they can actually get back after a specific period of time in the long term. But capital recycling is a big part of the conversation beyond the portfolio denominator effect that some of the LP portfolios had to go through in the past couple of years. So we very much look forward to that in terms of exits to provide liquidity. Last thing that I would mention on this specific topic on liquidity is that there's still, we very much look forward to seeing the development of the secondary market in Latin America, specifically for venture. It's been present for private equity and for other private capital asset classes for the longest time. But for venture, global pools of capital are still trying to understand how to underwrite the asset class and how to underwrite both LP stakes, GP stakes, direct secondaries for portfolio companies. And that's going to be a meaningful tool for managers to provide liquidity and DPI for their LPs and for those LPs to in turn return capital and recycle capital into newer vintages. But we are very excited to see that there's been some venture-specific secondary vehicles that have been raised or are about to be closed in the next couple of months. Then we'll be happy to announce them in due time. So that is that. I don't know. Maybe we can go to the final slide and then turn it over to our group of investors. So again, talking about exits and liquidity here, just to have on your radar that we are at LAVCA tracked more than 60 rounds that have raised more than $150 million in financing. Some of these companies have had different luck and have seen some evolutions again in the past couple of years. But the important part and key takeaway here is there are very specific targets of high quality businesses that have been developing in Latin America in the past couple of years that are going to have very important and impactful consequences when they realize an exit, be it by a listing, be it by an M&A or an acquisition, or even secondary transactions. And that's going to help develop and foster the growth of the Latin American ecosystem more broadly. So again, looking forward to the conversation. This is it for me. Please feel free to connect. Feel free to, if you have any questions, I'll be paying attention, and we look forward to keeping the conversation going. And please, maybe Nico Toro, the head of Latam for SVB, if you can kick off the conversation, that'd be great.
Thank you, Carlos. I really appreciate it. I always love diving into the report for everyone listening. You can find it at lavca.org. And with that, I'm going to invite our amazing panelists that represent some of the most impactful funds across Latin America. Antoine from Valor, Hector from Nazca, Lara from Maya, and Bianca from Alexia. And just a quick reminder to everyone listening right now, feel free to ask questions in the Q&A and we'll make sure to attend to those. So first off, I'm going to jump in with a question for Antoine. You know, the report shows VC activity in Latam has stabilized post 2022, with early stage deals making up 50% of the capital deployed in the first half of 2025. So what does this tell us about the maturity of the ecosystem right now? Are investors shifting permanently towards earlier stage bets, or is it cyclical? You know, as Valor does have some growth equity, I'd love to hear your perspective on that maturity and what that data tells us.
Well, thank you very much to SVB and LAVCA for having us. So really appreciate it, the opportunity to have this conversation. So Nico, to your question, I think I do think this is partly cyclical. I mean, we've just seen the history of 2021, and we saw the peak of investments there, and much of that funding went into later stage rounds. And the next couple of years after that were really spent, I think, with real attention focused on ensuring that those companies could live up to the promise and valuations of those rounds. And so there's a lot of focus on break even and profitability. And then you saw a number of internal rounds to ensure that that happened. I think in the last couple of years, though, you've seen much more early stage deal flow across the region. There's clearly a flight to quality. And I think what's going to be interesting to see is how valuations are affected in early stage. So it'll be interesting to see the correlation between amount of money that's being put into the early stage, as well as the number of deals, because I think you're going to see valuations probably going up in some of the early stage deals. You're seeing a valuation premium happening across the world with true AI companies. And I think you're seeing that in Latin America as well, where you're seeing some of the foreign investors coming in, investing earlier at valuations closer to what you're seeing in the US. So I think you're going to see some of that, but I think what's exciting is with all the early stage companies, there will be opportunities for later stage investments in the coming years as well.
And does anyone else wants to chip into that and see a new perspective on this? No, then I'll jump it up to the Mexican perspective, Hector. It's been 15 years, but it happened again. Mexican startups just overtook Brazil in VC dollars for the first time. Do you see this as a structural shift in regional leadership or a temporary rebalancing? And tell us what's driving capital to Mexico?
Good question. Hello, everybody. Thank you for having us. Well, number one, 15 years ago, the VC ecosystem in Mexico didn't even exist. So that's exciting at some point. What's driving it? I don't know if it's something to gloat about, but it's definitely something that is very interesting to talk about. Three things I would say. There's always a lot of things. One I would say is market client readiness. Specifically in B2B side, clients, early adopters, from enterprises to small businesses to the actual individuals were not ready for these startups, for these products. Remember, Mexico has one of the lowest consumer trust indexes in the world. So, getting ready for a new product, for a new service takes time. So I think that track record of, good NPSs, satisfied customers has trickled down, and the market readiness is there, which actually makes companies, takes you to the second point, which is the hub effect. So people are noticing that. They understand that Mexico is the largest market in Hispanic Latin America. Of course, everybody's going to either choose to launch in Mexico or to expand to Mexico first, just, for obvious reasons. Because of the market readiness, founders are electing to launch first or to expand almost immediately. And that has been kind of like redistributed a lot as Mexican companies, which they are, of course, because they start as their core market in many senses. So that's also driving the numbers up. And I think the third one that's actually modifying this is the capabilities and infrastructure that we have in Mexico. They were not before, they were developing. You saw founders spending a lot of money, a lot of time building things that they didn't have to build, rather than focus on their core business. They needed, just to give you a ridiculous example, but Carlos from Kavak this guy needed to build his own payment orchestration system, his own logistics routing systems. It's just, you can't focus on your core business because you need to build everything else because we don't have the capabilities and infrastructure. I think now we do. That is also attracting founders. That's also making companies rise faster, being founded faster, regulatory aspects as well. I think all of that summed up is what's making Mexico take off.
That's a very interesting take. And pulling on this, you mentioned business readiness and hubs. I want to pass it on to Bianca. I know you were just in Montevideo, which is a new emerging hub, but we see other ones growing fast. What makes a second-tier city attractive for venture activity? How can founders outside São Paulo and Mexico City compete for attention and capital?
Thank you, Nico, and thank you, SVB and LAVCA, for the invitation. It's great to be here and be able to discuss these points with everyone. Look, I think great companies don't need a Sao Paulo or Mexico City zip code. Right? They need talent, density, and capital availability. So, yeah, I've been spending a lot of time in Montevideo. I was also just in Florianopolis, where we also invested in a company. So places like these or Medellin, they're thriving because they combine specialized talent, strong universities, and local scale-ups that are recycling know-how. I think this is also important. And if you add supportive policies like the ones that Uruguay is having right now around tax exemptions for 10 years, digital nomad visas, or even community gatherings like Punta Tech that happens every January that is has a compounding effect, right? Plus, of course, quality of life. I think every ecosystem that has a very good quality of life attracts founders, full stop, right? But then you can attract both talent and capital to a place. And I think investors ultimately they follow traction. They're not following addresses. We have another example of a company that is flying high here in our portfolio, Locomics. That they're based in Curitiba, another hub in Brazil, and they raised all the way through Series B without being a capital city. I think I think the best way to compete is to lead with customer proof, and exploit local edges to turn them into global wedges, and use a distributed fundraising strategy that can compress in-person touch points into high density roadshows.
Local edges to global wedges. I really like that. And we're seeing a lot of that, nearly 500 new startups raised their VC rounds in the last 18 months, with Spanish-speaking Latin America leading. So Lara, how does Maya play in this ecosystem where, it's bridging beyond São Paulo? And what does this new pipeline mean for exits down the road? And how can we ensure capital availability for those growth stages?
Yeah, I mean, so first of all, thank you, SVB LAVCA. This is incredible. I think so for us, I mean, we're an early stage fund investing across the region, so we're always looking for the best players that are going to be winners eventually down the road, and by that we definitely mean exits. What we've been seeing it's incredible to see 500 new kind of startups on the track. I think that makes a really strong entry cohort, but as Nico, you mentioned, that's not enough, right? We need these are companies that are going to be exiting in 5 to 10 years. So until they get to that point, whatever the exit may be, there does need to be some evolution of particularly capital. I think capital can come, historically, particularly later stage capital has come from outside the region, mostly US firms. And I think in 2021, we saw that particularly with the big crossover funds coming in. But now I think for the first time, and this is exciting because I think complementing kind of this new cohort of startups, for the first time, we also have local capital that could actually support these companies as they grow into Series B, Series C. I think there's big, well-capitalized funds in the ecosystem, Valor being one of them. I think local investors, local private equities have been doing a lot more early stage. Family offices have been doing what they would consider later stage investments or growth investments. And so it's created this ecosystem of capital that can support these companies as they grow into what would be a size that would justify an exit. But for that to happen, we need to continue kind of structuring these local capital pools. We need to also continue attracting global capital, because global capital, in addition to providing capital in itself, it brings a lot more expertise, connections, and so on. And then finally, maybe even consider different types of vehicles, structured vehicles, growth, debt, hybrid capital, whatever could eventually be a possibility to help these companies kind of bridge that second valley of death as they grow into IPO or M&A size.
So yeah, let's deep dive into that. As working on a daily basis with all of you and being the bank for all of your funds, I constantly get calls from you saying, "Hey, can you help me with this early stage startup that we just invested?" But the matter is that the graduation rates from C to Series A are dropping sharply, as we discussed, reflecting that investor selectivity. So from the founder perspective, how should founders adjust their fundraising strategy now what does capital efficiency mean right now in Latam? And how can, the ecosystem support founders so that they can reach the next series? Antoine, can you touch a little bit on that?
Yeah, sure. I mean, I think, look, part of it is, so it's funny, when we started Valor in 2012, at that point you couldn't expect large rounds. So companies had to be very capital efficient from the very start, and they had to think about there was a scarcity of capital, and they have to be focused on capital efficiency. I think we've seen a little bit of that come back now. I think there is a focus for companies to say, understand when are they going to hit break even? How are they going to get to a profitability perspective? And they cannot assume that they're going to be constant rounds that are going to fund them through the growth. Now, sometimes that does happen, and that's great. You cannot assume it. And so I think being very capital efficient from the very beginning is very, very important. And I think that was actually a strength of the Latin American ecosystem early on, because you did have companies that were thinking about how am I as capital efficient as possible. Sometimes the irony is sometimes too much capital makes you very inefficient in operations. And now you have an opportunity with AI actually to be much more efficient in your operations. And so I think for founders, it's very important to think about efficiency from the start, not assume that you can get the big ones always. But if you do, and it allows you to grow, to still be thoughtful in the way that you grow your business. And I think that's key for all businesses right now.
What I would maybe add here,
Yeah.
sorry, what I would just maybe add to Antoine, I think in addition to founders being disciplined and thoughtful about capital allocations, as investors, we can do the same. I think in 2021, what ended up happening is that prestige or success was associated with the round sizes, which is very disconnected from reality, right? Because of exactly what Antoine just said. So I think what we can all do is also be a lot more disciplined in the way we allocate capital, in the way that we advise founders to allocate that capital, so that this efficiency becomes natural. Because I do think that Latin American entrepreneurship and Latin American craftiness has always been kind of a strength in the entrepreneurial ecosystem here.
Yeah, and to that point, I think that's a very valid point. I think everybody, both VCs as well as founders, rounds are not the outcome. Rounds are an intermediate stage to the final outcome. And so we need, like, just because you get a round that's 2x, 3x the last round, really doesn't mean anything. The only thing that means something is if you can build a sustainable business that has a long-term exit, right? And so I think that's something that we always have to remember. And I think back to 2021, there was a little bit of the hype and FOMO of, I need to have a big round right now, but that's not, and then I have to spend that capital. That's not the way you build a sustainable business. In the long term, I think we've all learned from that, hopefully. But I think that's what's going to create sustainable businesses and an ecosystem for the long run.
Thank you. And Hector, I want to throw it back to you. One of the main statistics that jumped out of the screen was that repeat founders have raised almost 40% of VC rounds over 1 million in the past year. So how do you balance backing proven operators with ensuring first-time founders don't get shut out of this ecosystem? And how are you seeing that evolve?
I think that's amazing. Having second or third time founders it's something that we've all aspired to have here. And I think that's great signaling. I think that it's proof that the cycle works, at least specifically for those founders. Even if it's a failure, it tells you that the ecosystem investors are actually valuing, a learning cycle out of an investor. It's not binary. Of course, it could have been maybe kind of like a mid-level kind of success, but everybody's looking to build something. And it also tells you that these guys are purpose-driven. It's not about money only. It's about doing something, getting impact, whatever their mission, whatever they want to do better, change. It tells you that because normally, when these founders normally get cashed out, they they literally check out. So, when they see these founders coming back to the table, raising capital again, building stuff again, it tells you about how purpose-driven Latin American entrepreneurs are, and I think that's amazing. And we're very happy. And it is a difference. You can see it. We have quotes from second-time founders saying what they are building today versus what they were building a couple of years back. It's a completely different setup. It's easier from a building standpoint, from a fundamental standpoint. It's harder from a fundraising standpoint. So, which I think it's overall healthier. It's more based out of merit, I think, and more selective in a sense as well. So overall, I think I'm happy to see that statistic.
Yeah, I do think it's very positive and also reminds me of the evolution of the magias or the mafias. And if anyone would like to touch on that, how they're seeing, I keep receiving more and more founders from former Nubank, former Meli, former Rappi, former Kavak recently as well. So I see that as a great evolution. Love to hear your 2 cents on this, Lara, I know you've invested in a few of these.
Yeah, I mean, in our portfolio now, more than 50% of the founders are second-time founders. And that's traditionally how ecosystems work, right? The success creates more success. It's very much a virtuous cycle. And from what we see is that these second-time founders, first of all, being an entrepreneur isn't easy. Being an entrepreneur in Latin America is a whole different ball game. Not that it's easy anywhere, but I think there's a lot of special circumstances here, particularly in terms of business building, that maybe make it a little bit more challenging. Having done that before is a game changer. So just having gone through that before, knowing exactly how to allocate capital, where to find talent, how to exactly go through that business loophole to structure an entity and that kind of thing, it doesn't necessarily make you a stronger entrepreneur. It just makes it easier. And I don't think that founders need to be second-time founders for them to be invested by a VC like Maya. I can speak for myself, but it's just what we've noticed is that it just definitely helps, and it makes conversation a little bit easier, and it makes funding rounds a little bit easier because they know downstream capital or downstream investors, and attracting talent, which at the end of the day is what the CEO needs to do, right, is also a little bit easier because they just have larger networks.
When we talk about finding the right founders to invest, we saw that only 16% of deals over 1 million went to women-led startups in the last year. So how can we, as an ecosystem, and what practical steps can we take to make investors expand funding and access to women in the region?
Yeah, well, I think here a huge shout out to Lara actually, and what she created a female force in Latin America is really important, because if we keep fishing from the same pond, we're going to keep backing the same founders. And even though I fully agree with what has been said about serial founders, on our perspective, also this is also a huge sign of a pattern recognition on lessons learned, which is important. I think it's important for us to find new pools of talent, right? And so here at Alexia, we're actively broadening the top of the funnel by sourcing through women's founder networks, such as Female Force and others, right? Angel operator groups, such as Sororité. And we have structured also something that is important, which is how to have first screenings that reduce bias. And this is fully by actually empowering our team on how to actually understand which unconscious bias we might have. And we also plug women founders into advisory pods. So for us, this is also looking at alpha, and we really believe that in finding these new pools of talent, it's important to find opportunities of overlooked founders.
And Bianca, talking more about opportunities, we couldn't have a panel right now in this time and age without discussing AI. And I know that AI is highlighted as a key strategic priority for Alexia. So I'd like to get your 2 cents on the state of AI in Latam, and where do you see Latam startups carving out defensible niches in AI? given all the global competition and what's realistic versus what's hype in terms of AI in Latam?
Yeah. No, we're constantly gathering groups to discuss really what is the impact of artificial intelligence and everything that's happening to the Latin American ecosystem, right? And we think that, look, across the board, defensibility in AI won't come from fine-tuning the biggest, largest model. I think it comes from owning the hardest to get data and combine it also with workflows. We really believe in the application layer, solving so many of the potential, opportunities here for improvement, for efficiency in Latin America. We think that the real opportunities are also in regulated data workflows. We have a company in the healthcare sector like Neuromed that is using medical imaging and NLP and specific regulatory approach. Also, a content marketing intelligence rooted in Spanish and Portuguese media graphs. This is also something that could be an important moat. And I think that when it comes to what's hype for us is when you have thin wrappers on foundational models with no proprietary data loops. We think that that's really hyped and something we're not looking at. And we invest where there's a wedge into a workflow that can evolve into a system of record. So this is super important. The other very interesting angle that we're seeing is roll-ups of traditional service businesses and how actually AI can make the operation of law firms, of accounting firms so much better. And there's a huge opportunity in Latin America for that.
Does anyone want to chip in and tell us more about what you're seeing from your fund in terms of AI and what the strategy is for the fund?
I think what Bianca said is extremely accurate. And what we're seeing, to top up that is everything that, the entire prompt to action wave that is happening around the world will need local infrastructure. So kind of like the core layer is going to be relevant, kind of like what happened in fintech is going to happen in AI. So there's two things that we see, like everything that goes into action will need a local connection. That means talking with the telcos, talking with the banks, talking with the retailers, talking with whomever you want to do the action or see the action in, either software or physical businesses or, whatever. All the prompt to action needs to happen or needs to be connected somehow locally, and building that layer is going to be extremely powerful. What people are finding out as well is that, different to the first wave of software, AI uses a lot of edge computing, if you want to say, like for the audience, it's like it's not all processed in the cloud. It's going to be processed either in your devices or in an immediate server or local kind of infrastructure. So there's a lot of opportunities there as well. People are coming. And I think, just to top up what Bianca said, I think those are massive opportunities in Latin America that have a huge moat. So I think that's where we encourage for people to look out.
And touching on your comment, we continue to see fintech dominating the Latam VC for years. Graduation rates for fintech seed startups are much stronger than other sectors. So do you continue seeing fintech as the main engine for returns, or are you shifting to newer verticals like health tech, logistics, or others?
I directed to me, Nico, I imagine.
Yeah, I mean, we can direct it to you since you touched fintech, but we can pass it on to Antoine.
Fintech, of course, there's a lot to fintech. Actually, there was a question in the chat, that how do we define fintech, right? But it's very broad. You can go from all the infrastructure and the rails all the way to lending and etc. But as long as we have uncapped interest rates in some places of the region, like Mexico, I think fintech is going to still be attractive. So that's a part that probably will start to trickle down as soon as we see some kind of regulation, capping interest rates. For example, you cannot buy ads anymore in Google or Meta if you have an interest rate above XYZ in the region, for example. There's private caps already. So And that's the main driver of most of the value right now, at least the end value, because everything trickles down to if lending works, that generates lots of value. Then, the KYC engines work and have customers, and the structural things work, and the rails work, and the payments work, and everything. So I think it has a lot to do with that. So as long as interest rates are up for clients, I think it's going to be very attractive. There's a big ethical question around it, but I think that's something that we're seeing.
And I want to, continue discussing like the different players and that we're seeing. There's the regulators, as you mentioned, what's going on with Google Ads, but there's also a larger stakeholder playing a big role, especially in Brazil, which is corporate VCs. So, Lara, I'd like for you to touch on this, but corporate VCs are now present in around 15% of deals. I know that whenever I go to Brazil, I see more and more CVCs. And what role are corporates playing in shaping exits in the ecosystem maturity? And are they competing with or complementing traditional VCs? And how are you playing with this new and larger stakeholder?
I mean, corporate VCs, I think the most exciting part of having them on the cap table is the strategic validation, right? Like a company would never invest in a startup, a large corporate would never invest in a startup unless they actually saw a lot of value in that company. So of course it can create some sort of conflict of interest down the road, but if done in the right way, I think that CVCs can be extremely helpful to the company and eventually to the VCs by providing this kind of very strategic and specific knowledge. I also think it demonstrates a lot of ecosystem maturity. So corporates, in many cases, global companies coming to these more local ecosystems, they can eventually create not only distribution channels that can eventually become global, but also bring a lot of credibility to these companies and to the earlier stage companies. So in the end, we like working with CVCs. Of course, I think I don't think there's a competition issue because I think the best startups will, at the early stage, have VC funds, and then as they grow, kind of bring on these strategic partners. I do think that there can be conflicts of interest if not done correctly, and the ecosystem maybe still needs to mature a little bit for CVCs to properly understand that for them to really be able to avoid, I guess, like negative selection, they'll need to play fair and invest alongside the VCs.
Yeah, it's definitely a lot of lessons to be learned there for both players. It's a very interesting question that we're all gonna continue to learn from as the ecosystem evolves. And talking about how the ecosystem evolves, and we're closing up on our time here, I want to ask each of you to imagine that we're in the year 2030, 5 years from now. What do you think will surprise us most about the Latam VC ecosystem? Is it something about the sector, a country, a specific company that you're betting on, or a structural shift in how capital flows? I'm gonna throw it off first to Bianca. Tell us how you see 2030 and what surprised you about these past 5 years.
Well, I mean, maybe recapping some of the themes that we have already touched on, right? But I feel like one theme that is exciting me, and I think it's increasing over time, is the fact that some of the best startups won't come from developed markets and won't come from the largest cities within our markets here in Latin America. They might not come from Sao Paulo or Mexico City. They can emerge from places we're barely starting to track today. And I think another theme that is important we touched on, and perhaps one of the most important aspects is efficiency, right? It has been said here that it has always been a LATAM superpower, and I think it will continue to be a superpower and not a constraint. We have been raised how to actually turn every dollar into not only efficiency but into moat. And I think that all of the hurdles that we face in Latin America in terms of regulatory ecosystem, in a way, it also shapes the most resilient founders. And so, to me, I'm eager to see what the next 10 years are going to look like for the best founders in the region, and being able to create global plays.
Thank you, Bianca. What about you, Antoine? What do you see in the cards for the next 5 years in our ecosystem?
I see a few things. I think, first of all, you were discussing fintech being a vertical and how big it's going to be. I think you're going to see more and more fintechs actually more of a horizontal, and you're seeing more and more companies that are adding fintech to their business models. So even when you see commerce as the second largest vertical, we're seeing a lot of revenue for those companies in the commerce space actually coming from the fintech side. So I think that this idea of fintech being the largest vertical is actually almost a misnomer, because I think almost every company will have some level of fintech in it. In the same manner, I think every company will be an AI company in some way or the other, either through efficiencies or using AI for their business model. Again, I don't think Latin America is going to be leading the models, but the advantage we have is huge data sets that exist in Latin America that have barely been utilized or penetrated. And I think that's where you're going to see very interesting things happening. And that's where you could see more interesting business models in sectors that have been very hard to penetrate, like healthcare, for example, which has huge regulatory issues and has been very, very difficult to build big businesses in Latin America. But I think with that, logistics, et cetera, AI opens up a new opportunity in Latin America to take advantage of those data sets. And so I think that'll be something that's interesting. And finally, I think from a capital flow perspective, I do think you'll have foreign investors coming back, but very pointed. I don't think you'll have a mass 2021, like, spreading money across a lot of different companies, late stage, just hyping up the valuations. But I think you will have very pointed investments made in models that they understand from other markets and seeing the opportunities that we have in Latin America. So those are some things I see.
Thank you. Lara, what does your crystal ball say?
I think in my opinion, I think it's a matter of time before we start seeing more exits coming out of Latin America, and that what we hope will kind of catalyze the ecosystem and create what we've already spoken about today in the call, and that it'll flush the market with talent then attracts capital creates more examples. With the amount of companies that we're seeing being founded by the quality of founders that we're seeing, I genuinely think it's not if, but when we see more exits. Maybe they won't come in the form of, they probably most likely won't come in the form of local IPOs right from the get-go, but maybe in the form of local M&As that then become international IPOs that can then open the door for the local capital markets.
Thank you very much. And Hector, to close it up with you, also, if you can add, because we just received a question to Q&A, within those 5 years and what you are seeing and hoping to see, how do you see the role of late-stage funds within this?
Sure. Next 5 years, well, you asked two questions. What surprised me most the past 5 years is the amazing resilience founders have in the region. It's amazing how they learn, adapt. I'm like honored to be part of this industry. They're amazing, and it's unbelievable how good they are, how they adapt, how they solve problems, and companies that had a pretty bad outlook are suddenly becoming extremely attractive, and that's thanks to them. And I think that's impressed me. What I think is going to happen in the next 5 years, I think there's going to be huge structural change in how we invest. Well, not how we invest, but the way that we perceive liquidity, the way that we separate or disassociate liquidity from exits, the way that we combine venture capital with other asset classes. the way that there's a huge structural change coming. Remember, what we are all operating under is something that we inherited from the private equity industry, and it just doesn't work or doesn't work great. So there's been lots of changes in the US that are trickling down in Latin America, and we're probably going to see them going mainstream probably next year. And I think that's going to be huge. There's going to be more access to the asset class, not only institutional or high net worth individuals. There's lots of things going to happen. So that's what I think is going to happen in the next 5 years.
Seems like we have some very exciting 5 years ahead of us. And with that, we are at time. Thank you so much, Lara, Hector, Bianca, Antoine, for your participation, our long-lasting partnership with SVB, and hope to see you very soon in the market. For everyone that attended, we'll be sending out the recording of the webinar. Thank you very much and have a great day.